9 days ago, we discussed the idea that the NASDAQ and semiconductors, along with other asset classes, were starting to hit their lows. Fast forward it to now, we've moved all the way up to one of the best returns since 2022. So, does that mean we cancel the recession fears? Has the hard landing gone past us and we're in a soft landing narrative? Well, a lot of that depends on which side you're on. And in today's video, we'll take a look at everything moving forward for both ends of the market. More importantly than that, though, retail sales. They managed to help squeeze the Russell 2000 through those highs. And that means there could be actually some very interesting runs on the markets. But also, what about a dip? Is there going to be one? With two gaps left behind, a lot of people are looking for a cheaper price on the S&P. Could you be waiting till the end of September for that? With silver breaking out as we suspected, and of course, crypto still floundering, there are still opportunities in these markets. Let's come from the abundance mindset, guys, and go through stocks, commodities, and cryptos to see where the best opportunities lie for us as traders and investors. Well, welcome back, everybody, to The Daily Show. My name's Tom, and as always, we go through the markets together, including the macro, the data, and everything we need to know about the key levels on these charts. It was a pretty good day for markets across the board. The strong retail sales numbers smashed the analysts' expectations, and it sent things like semiconductors into absolute bullish, ballistic mode. But is it all good? Well, I want to start off with a quote here. And of course, this is a quote I think that'll be very important into the back end of 2025 and into the beginning of 2026. Stocks are built on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. John Templeton. Bookmark that over on our X account. Make sure to follow in the links in the description down below. Why is that so important? Well, as you may know, I've been talking a lot about late cycle. Now, a lot of people think that late cycle is 1 month and then the market crashes. Actually, it's the last 2 years usually. And we've been discussing that this year. We've started to see the rise of defensive markets. Utilities, gold, and other asset classes are starting to do better. They are all signs that we are in late cycle. And this is the point where you're going to feel the most amount of FOMO. Generally speaking, you're going to have to follow these markets up into the blow-off phase, but you need to be very, very careful. Let's have a look at some of the bullish catalysts. I wrote these down as we saw the retail sales number come out, which was very good. 1% versus 0.4% was pretty spectacular. And we saw huge moves across several stocks, with Walmart absolutely blowing out in terms of how well it did in its earnings season. Their move to online into the e-commerce space has been phenomenal. We've got a stat on that a little bit later on. Buyback periods are now happening to September 6th, 4.75 billion per day, obviously a bullish catalyst. We're in positive gamma at the time of this recording, obviously a bullish catalyst. And of course, we had a strong post-VIX crash recovery data, which we talked about at length over last week, which hopefully helped galvanize quite a few of you into feeling a little bit more comfortable with the market. It's not often you see a flash crash followed by a instant recession. It shows you fragility in the market, but it usually is just that, a flash crash, which is bought up. Inflation also has been slightly improving, although we talked about shelter in the previous video. So all of those are interesting facts. But here's one from Campbell Harvey, and it talks about the soft landing pros and the hard landing cons. And I'll let you go through some of these, but I think probably the most notable ones are obviously that we're starting to see real-time inflation underneath 2%. We've obviously got big banks having lower leverage than you would expect, although I'm expecting that to change quite a lot as we're seeing debt being written out of control. US is relatively immune to geopolitics at the moment due to the nature of where the US is. Of course, that is kind of a positive thing here. And obviously, we're in the AI bubble. The AI revolution will benefit the US. Yes, of course, the greatest innovative companies are doing very, very well. So unemployment is rising, but obviously the rate is low. We're coming off a super base. And all of these things, they're definitely pros. But as I said before, I think our pros for the current bull market really take into consideration not so much the macro, but what actually is happening in terms of the options market in particular. A lot of people have been caught off guard trying to short this market and getting absolutely smashed. I'll bring that into our weekend video so you guys can see how bad the leverage really is when people are trying to short this thing. We are climbing a squeeze against people trying to short it. Hopefully not too many people out there have been caught on that one. Fed has kept rates high for too long. Obviously, yes, the Fed will always do this. They'll break something. We know that when they start cutting, they're cutting not out of the goodness of their heart, but they have started to break something. and generally that will lead into recession, which is why we think we are still in late cycle. The SARM rule, yield curve inversion, never forget yield curve inversion, guys. And then, of course, we've got consumer savings are depleting. Everyone's living on debt, which will go over here to become a problem. $9 trillion in deficits over 4 years has reduced flexibility of course, the US to be able to fund and do new things. And 36% of income taxes go just to pay the interest. So, of course, the Federal Reserve will be interested in getting those yields down as well, so that they're actually less of a burden in terms of how much debt there is in the markets. So some interesting stuff there, along with, of course, commercial real estate having some problems, and you have a hard landing and a soft landing narrative. Now, at the moment, I think, while the hard landing narrative is certainly there, we have to look for the signs underneath the hood. And of course, we do that every day here on the channel, so make sure to subscribe. But one of the things that isn't bad right now is how good these retail sales numbers come out. And whether they're real or not, who knows? But the point is, this was the expectation and this was the reality. This is a very strong number. And you'll notice that when you go back through the history, this is a very, very strong number for retail sales. Now, however that happened, whether it's Prime Day or something else, who knows? But it didn't actually go into Amazon stock as much as you would think. We did see a lot of the overall XLY improvement across the board. It wasn't just one thing. And this led us on to seeing high yields, but still seeing the RSP, the equal weighted market, do very, very nicely. In particular, the Russell 2000 started to go ballistic after they saw the retail sales numbers. And I thought I'd bring this chart up here from Grant Hawkridge over on X, because it's a very interesting chart. And what it shows you is that the Russell 2000 is notorious for being an underperformer. But when it starts to outperform, when it starts to make a new all-time high, I don't think you want to be against the Russell around that point. Now, of course, there are some all-time highs that are a little bit dodgy. Like over here, we tested it, we went off, and then we came through with a vengeance. But when you break it, and you break it well, they tend to overperform. So the Russell 2000 will be coming up soon, hopefully, to a very interesting point. The all-time high is not that far away. It's only at 242. We know we've started to see what looks like a bit of bullish impression, so keep this one in the back of your pockets. Another reason why markets have been rallying so much is this chart here. We talked about CTAs, and we talked about how they've been underperforming, how they got smashed last week and had to sell a lot, and now they're underinvested. Well, they've had to pull back in with their systematic funds heavily over the last week, and whenever they've fallen this low below price, it's usually been a very bullish sign for market recoveries, and we've seen strong purchasing of the CTAs. I'd expect this to go totally vertical when we get the next read on it, and of course we'll be tracking that along with the new surveys that are coming out, which of course will be interesting to watch on our weekend video. In terms of percentage of New York stocks under at their 10-day lows, 1-month lows, or 3-month lows, we can see that's dropped off considerably, as we've seen a fairly decent breadth uptick as this market's pulled up. And then, of course, there are the VIX stats. Different ways to look at it. This chart here from Grant Hawkridge, again showing when you get these high VIXs, and remember, we actually got a 65 VIX pre-market, but by the time the market opened, it was around 40. You can see here that this still means overall positive yearly returns. If you start getting a lot of volatility, that's when we want to be more concerned. Check out our last video. We have some great stats there. We also need to consider what time horizon are we in. Are we in late cycle, 1998, 2018 periods, or are we just before monster crashes, 2020, 2008, 2000, those types of periods? Because those ones with high VIX, yeah, the returns are absolutely shocking. We're looking at between 20 and even 50% off the markets. I tend to believe that we're at the point where the Fed is going to try to engineer a soft landing. They're going to stuff it. We don't know that yet, of course. We think we're going to get 25 basis points in September, and then we'll go from there. S&P 500 forward PE metrics, of course, not cheap, not as expensive as it was in 2021. Based on the retail sales, we saw huge curve changes. We're now only seeing 26% chance of a 50 basis point hike. How things change over the last week. And obviously that brings us to the non-recession potential path here, the soft landing path. Because we saw a flash crash, we're recovering pretty strongly. We expect possibly a little secondary dip late September into early October. We're in the buyback period, which is strengthening the markets right now. And then the idea that maybe we go through to having this really ridiculous return over the next 6-12 months, and then we have a recession could be still on the cards. Remember, in late cycle scenarios, it's very important that we only get around a 25 basis point cut. If the Fed does a 50 of the last 5 cut cycles, yeah, I think we all know the stats. If they do a 50 basis point cut, we are in big trouble, it looks like. Let's have a look at the performance of the S&P 500 with Wayne Whaley's data. As we know, September 23rd, October 2nd, when we've had a similar events of bad starts to August, good runs from January to July, it tends to be there that we see the most amount of weakness. And that actually does bank in well with a lot of the stats that we've been showing on the channel. We also have the Whaley Breadth Thrust, which we know is 100% read in recent times with strong 6 and 9 month kind of returns. And I just thought I'd kind of give a shout out to Walmart here. Have a look at their movement into the e-commerce space. They've gone from these hideous percentages back in 22-23 all the way into a magnificent amount of e-commerce net sales. So whatever they've been doing really well. And it does, of course, feed back into how well the stock's been doing since that point. It's absolutely ripped another 8% or something just off the earnings. If we talk about dark pool activity, there was probably a sell of profit. We finally got some type of read coming through. This is a normal big read on the markets. We've seen this trade happen a few times before. We know this is a heavily traded zone for the Qs, and it's something to keep in the back of your mind. We're at that last level for the markets to find some type of resistance. Let's now move over, though, to the S&P 500. What has it been doing? Well, it just went ballistic after the retail sales. It smashed through everything. We're in positive gamma situation, so it started to feed upon itself, and it led into a very nice return by the end of the day. We're at that last point. As you can see here, we've got the resistance or the supply, and this 55.50 zone is pretty much one of the keys. Some things to note for dip buyers that might be interested is that we have left a couple of gaps behind. Down here, we did pretty well. Obviously, we got close to this gap here. I guess you could argue. Some people would say that's filled. And then we have 2 up here that could be kind of the point here. And that would actually create a beautiful inverse head and shoulders if that was to occur. Let's have a look at the futures market, though, and see how that's been trading. So we've updated the one-day options expected moves. Remember, the market is expected to hold within these zones 68% of the time. We've marked out the 55.50, which is the last major kind of bear zone. And that doesn't mean just go short it. I wouldn't short the area unless you had a replicable setup. And we spoke about that in the last video. We don't have any signs of weakness. We put in the mark level that we thought we would have weakness at if it did break underneath. And guess what? It's just kept going and going and going. And a big reason behind that, in my belief, is not just positive news. It's squeezing shorts that have gone in early and also squeezing the positive gamma side. So if you have a look here, look at these calls. They're everywhere. Plague amounts of calls have now come back into the markets. And as you'll notice, we're on the positive gamma side. So 55.50, that is pretty much the call wall today. So if the markets break through that, they could continue to squeeze higher, create massive weekly closes. And of course, that'll be significant. What you will notice, though, that whether it's the 16th or the 19th, which is of course next week, or any of the other dates here, we're starting to get a huge stack on 55.50. So it is clearly a zone that I think day traders in particular will want to be watching. You'll also notice that the positive gamma becomes more switched on the 19th towards 5,500 as well. So there's a lot of striking around here, a few different puts starting to come around this level. There's a war, I would say, around this zone. So certainly want to be paying attention to how the market structures. If there is a little sign of weakness and it actually is in a structural replicable state, then this would be an area where a day trader could come in. Just like that other area we saw the other day. If you get the right setup, yeah, I mean, it could be a point where we've overbought. Maybe we're moving towards those gap levels. NASDAQ versus CTAs. We know that these guys, once we get the updated data, are going to be going ballistic. They're going to have to because they're caught again underinvested. Same with the S&P 500 CTAs. With copper, they started picking it up. Had a great copper session, previous session. Silver still looks weak on the CTAs, although it had a beautiful risk-reward trade on it that we thought might be coming through. Brent, again, up and down all around with the CTAs. Gold got shorted off pretty heavily, which was an interesting one. That was a few days ago now, but again, gold needs to break the weekly to get really strong. We are still bullish on gold. And if we have a look here, you'll notice that it is a positive gamma across the board. Things like NVDA, 120. Again, it would make some sense for the markets to try to push underneath 120 by the end of this week's expiration, just to make a bit more money. we're in positive gamma. If the market starts still rip and they want to rip even more, 126 would be your target for the next session. But if you're looking at it, I would say that there's a decent chance the market will try to get back underneath 120 to not pay these calls out. Very strong movement though, and you'll notice that each week now into the different OPEXs, we've got very, very strong call buying in NVIDIA. So, this is right at the res across the S&P, across the NASDAQ, and across many other markets. So yeah, you could see a little bit of a pullback. 210, very strong here from Tesla, one of the best performers of the day, up to 220. This one's a little bit different. Although there are a lot of calls around this area, and again, it could pull back, it hasn't had quite the runs on it that the other stocks have. So again, very, very heavily kind of geared towards the positive gamma side, and a lot of strikes all around the current price. 220 would be the target. I guess we're still going to set that as our target from the previous sessions. Let's move over now to the charts and have a look. Consumer discretionary versus staple, still stuck in terms of halfway, but nice day for consumer discretionary. Mostly thanks to this one here, Walmart, which ended up 6.58% up by the end of the day. I wouldn't chase this trade, but a few people were in this in naturally our private community. Congrats to them. They were buying this thing up before the earnings. And yeah, it did very, very well. So I'm surprised how well it actually did. US 2-year, you can see here a little bit of a spike up in yields. And more importantly than that, if you're having a look, obviously we're watching for yield uninversion, and that's moving further away again since the strong numbers. So we went from being in a hard landing recession style period to all of a sudden, okay, we're going to go back up for a little period here. I'm still looking for the day we get the uninversion of the yield curve properly. When that happens, I think we're on a timer, and we will update on the channel, so make sure to subscribe when that does occur. TLT is surprisingly resilient considering yields have gone up. This is still one of those ones that if you're holding it for a long period of time, 12, 18 months, probably going to do okay. But if you're trying to trade it, yeah, it's not as easy. So around here is where we've seen a lot of dark pool buying. I would think that the street is purchasing it. And obviously Warren Buffett's a pretty big fan of the old bonds and treasuries at the moment, with cash stockpiling all over the place. Dollar index, no break under 102. We'll keep watching that. If it does break underneath, it should get a big move. Gold just holding as well as it can, looking for a weekly breakout of 2485. Haven't seen that yet. And silver hit first take profit level. Now, a few people in comment section said, I'm still talking about silver. You got to remember, guys, we liked silver at 26.50. All things being equal, it's still up 6.11%. And you've got to also remember, because it was lagging, these trades, especially the silver trade, could have easily been in over the last 24 hours, last 48 hours. So, there are several things you want to be doing. You initially buy what you know is going to be good. In this case, we knew NVIDIA was the number one target for us in the markets. We talked about it at great length, the gap fill at 95, 92, that area, and we thought that would lead out. And it has. It's led out. It's done very well. The NASDAQ would obviously recover the best. It has. The S&P 500 would recover the best. We didn't really like the Russell as much because, of course, we know the Russell comes secondary. It's kind of like the crypto world. You usually go Bitcoin, Ethereum first, and then the rest of them. In this case, gold's been doing well. There is still a underpricing of silver in the market, and it's still making a series of higher highs and higher lows. So if you manage to get your first take profit out there, cool. But if this thing manages to break through 29.50 in the future, it's also good. And you've got to get rid of your prejudice towards, silver's been a terrible investment for a decade and everyone lost money. Yeah, everyone did lose money, but they don't understand silver. This is a lost decade. If you were buying silver over here, that's stupid. We were in a totally different market. We were in a deflationary boom. That is not when you want to be buying silver. You do not want to buy silver in a lost decade, but we're now out of that. And you'll notice that sometimes silver goes on ballistic runs. So I'm not suggesting it's doing that yet, but it certainly is a lot cheaper, and this is a fantastic zone. We'll keep watching on the channel. Hopefully you guys like it in the comments down below. I know some people aren't loving silver or whatever, but you should love anything that has good replicable trades. And that's why we've loved copper, oil, silver, gold, many other things, because guess what? They've got good replicable trades. And ultimately, shouldn't you really be just looking at great risk rewards and great Sharpe ratio style positions? Let's talk about oil. Oil came down to our area, and we have seen a response from that, which is great. So well done. Then we're moving towards 79 plus. We'd like to see that breached out. If it does get breached out, it could give us quite a lot more strength on oil. I think we're looking at around 83 a barrel if that does occur. Tesla, obviously we said, moving up. 220 was our target, and it's almost there, 214. Nice move from Tesla. positive gamma situation, obviously, across the board here. NVIDIA smashes straight into its finalized high, 122. If you took profit at 117, 118, like we kind of said, if you bought it off these lows and you were trading it, that's actually a really good zone to do that. Now, if you've got long-term holds on it, of course, we believe it will go to an all-time high. Why? Because we're in an AI boom, and this is the stock that has to keep driving it if it's going to happen. Earnings is coming up, so it's not too far away now. It's coming down and down and down, getting closer, but this is still a resistance, and we're hitting them all at the same time. The S&P 500, the NASDAQ, NVIDIA, etc. I would expect a slowdown around here and consolidation, if not slight drop, but that doesn't mean I would trade a short. I would basically just be looking for the signs. If you get a sign, that could be, a good kind of go signal. Now, speaking of go signals, have we just seen it on the Chinese stock market? HSI 17,400. Set my alert. I got a hit for it before. Looking for a closure above this area, of course, but this is a beautiful inverse head and shoulders. Things are starting to improve. Obviously, a couple of earnings catalysts that are good. JD, Baba, Tencent, all pretty positive across the board. So certainly the Chinese stock market looking better than it has for, I would say, about a month. Yeah, for sure. Looking really, really good there. US 30, again, the Dow kind of hitting this trend line here. Very strong movement of the Dow in the last 24 hours thanks to core retail sales. The best one, though, was the US 2K. Snapping this candle that we didn't believe in was very, very nice. And as I said in our private community, links in the description down below, to me, it was like a scale-in concept. You could have even though that looks horrible, you actually could have bought some with stops below. We know this is a heavy trade zone. And I'm looking towards the Russell starting to perform better. Remember, if the Russell does manage to get through the 24, whatever it is, 30 zone, the new all-time high, historically, that's been a pretty good run space for the next 6 to 9 months for the Russell. And I think that's something that someone like Tom Lee and Fundstrat are trying to work on. At the moment, that is still a very strong kind of daily looking candle break. And hopefully there's more to come in the Russell moving forward. We're at a very strong level again for the NASDAQ, as we know, all sorts of moving averages and all sorts of things sitting here. Previous supply that we reacted to, obviously the notable resistance. And really, if it gets through here, well, of course, it's going to an all-time high. So will there be a pullback? Will there be some gap fills? You can look at the cues if you want to see where the gaps are. So make sure to load those up and mark them. My kind of thought process is if we do see any selling, it's probably going to be stopped by around 450. So on the cues, so certainly something to watch. Let's have a look at Bitcoin. Could be really interesting. We've coiled to the way down here. I've got a super bull level set at 50 or 60K. If it breaks through 60K, I think the market is looking really nice for Bitcoin. There could be an excellent trade here, and I will be watching. And of course, we all will be together. Ethereum, on the other hand, still kind of just going up, down, all around, sideways. The same trade on Ethereum would just be breaching through this high here, around 2,700-ish. And if we get through 2,700, that would be strong. It is all coiling. It's super underperforming now the rest of the markets. It's actually doing worse than silver in some ways. And yeah, that's what crypto does. Crypto tends to be a risk-on asset. When everyone feels good, it's going strong. So 2,700, something to watch on Ethereum and obviously on Bitcoin. For the news ahead, there's not that much. And of course, going into Friday, some people are worried about prelim UOM consumer sentiment. That is not usually a piece of news that matters that much, but there is more coming over the next week. So remember, if you enjoyed today's video, if you're new here, make sure to subscribe. Check us out on X as well. And if you want to learn more about replication, because remember, trading or even investing is all about replication, doing the same thing, rinse and repeat, keeping it simple, keeping it smart, and more importantly, getting your ratios up there. You want to be making at minimum, ideally 2 to 1 on your risk reward. If you risk 100, you want to make 200. If you risk 1,000, you want to make 2,000. If you want to find out more, day trading masterclass and advanced masterclass might be good for you. Thanks so much, guys. We'll see you in the next one. Bye for now.